if you look at all the listed companies, or you take the Sensex companies, the major shareholders, if you remove the promoters, which is in excess of 50%, majority is held by foreign institutional investors. And in spite of that, we are a very, very shallow market. A country like South Korea, on a single day, if the FIIs or foreign institutional investors sell even 1.5 billion worth of stocks, you find marginal movement or marginal negative movement. In India, even a 50 million or even 100 million sales done by FIIs, maybe 500 points down. So it's basically a shallow market. It's basically only the foreign institutional investors who are present. Retail investors, very, very marginal. I think just about 5-6% of the Sensex companies, which includes also the HNIs. So it's a very shallow market. Though I think we have post-liberalization after the advent of NSE, National Stock Exchange, every single nook and corner of the country is at least exposed to stock broking activities. And I am very, very proud to say that I think India is one of the most advanced trading platforms in the world. Much, much better than what is even available in the US. So US, even today, it's a combination of outcry system to, online system and stuff like that. But I think today we have, and the number of trades what we put through per day is reasonably high. Domestic institutional investors still are the banks, some mutual funds, and there's a lot of things that can be done. So that is the status post and pre-liberalization. I think three of us have spoken enough. If we speak more, then they may not have any topics. It's always like that. The last guy gets nothing to speak. He'll say, I agree with all these things. So I leave it to Abhay.
Hello. I'll start by saying I agree with all these guys and try to quickly jump on to the next part, which is about where do we go from here. We have come a long way. I'm sure all of y'all as well remember being part of the debt capital market for most of my career. We used to be on 2 phones with brokers, 1 phone under each year, trying to sell along it at GSEC. Was changed when the negotiated dealing system came into place, which was roughly 10 years ago, probably sometime like that. The new systems obviously do provide a lot of transparency in prices. There's a lot less scope for any price manipulation. Several of these changes have taken place. Going forward, what I believe is what Mr. Pai had touched upon. Globalization is something that we cannot avoid. That is the only way forward. Indian economy and Indian markets will always be more and more interlinked to global markets because there is really no other way to move forward. We can't operate as an isolated economy and an isolated market. To move forward, what I believe is the road will be paved by our regulators, essentially SEBI and RBI, and it will be treaded upon by all of us participants, be it banks as investors, be it mutual funds, be it FIIs, be it retail participants, be it arbitragers, be it anybody else. SEBI and RBI and other regulators, be it IRDA or anybody else as well, they have had a safe rather than sorry approach, which has worked to our advantage. Even post the 94 crisis, or you can talk about 2008 crisis, People have commended these our regulators on being slow, but because of which they were probably held in the to benefit, because they were able to withstand huge crises that would have probably affected us had we gone on an aggressive path. Uh, so going forward, where we are still lacking in terms of products, I believe the changes will come in due course. They have been coming on due course. We have a lot many more products available for investors as compared to say even 5 years ago. Professor Vishwanath also mentioned on onset of commodity exchanges or currency exchanges. Now I as a retail investor have an opportunity to take a position in a currency futures market, which I didn't have say 3 years ago. I as a corporate investor or a corporate have a choice to hedge my commodity risks, which I didn't have say 8 years ago. So all these changes have taken place. There is obviously a long way forward. For example, talking about currency markets, options being traded on exchanges have only very recently begun, and they don't have much depth. They don't trade so heavily. Obviously, retail participation isn't there. On commodities, for that matter, we don't have FIIs investing. We don't have institution investing. Even I, as a bank, or I, as a mutual fund, I'm not able to take positions in commodities on the futures exchanges. These changes will take place. They will take its time. It will happen slowly. But these are the ways forward. How it will be done by the RBI and the SEBI and the regulators will probably unfold in a very slow manner. But our experience has been that this has worked well for us. I believe this will be the way forward as well. A few other things as well, what Mr. Manoj Shenoy was mentioning, our systems being on par with the rest of the world, if not better. I have not experienced international systems as yet, but I have met enough people who have also reciprocated by saying that Indian systems, Indian trading platforms are on par, if not better than most other platforms. Some few things that add credence to this fact is, say, the 2008 crash. I personally handle the broking community relationships for my bank. There wasn't any default on the exchanges. Can you believe the amount of panic that would have happened in the market if there were huge brokers defaulting on their payments to the exchanges as well, on top of the market prices falling? As an investor, I would not have the confidence firstly on the market, because I am exposed to market risk and price risk, but I would also have been exposed to huge settlement risk, because my broker won't be able to pay or take care of my obligations. These risks have been pretty much mitigated by strong systems which have been put in place by the regulators, which has helped us in good stead. Going forward also, like I would like just to reiterate and close, this will be the way forward in my view. It will be slow, steady, but it will help us in the long run.
Yeah, I think being a last speaker is good as well as bad. Nowadays, everything what needs to be told has already been said. Bad is I don't have anything to add. Okay. One or two things as a project finance professional, I think we feel very disheartened that nothing much is happening in the capital market area. Because if you see last 3 years, 2008, 9, 10, the total resources raised out of capital market has been dealt. Come down, but 2008, 2009 has been lesser, 2010 is further less. Now, what it means is it puts a lot of pressure on banking system. A lot of money, because India has to grow at the rate which it's growing. It needs a lot of money, and that money, majority of that money is being supplied by banking system today. And banking system today is saying, "Boss, enough is enough. We don't have any more appetite. We have reached our capital adequacy requirements. We have reached our exposure limits. So something needs to be done. Money has to come from some other source, so that these investments can take forward. These investments can happen." So I think yes, there is a lot of developments which has happened in the capital market area, but I think in terms of developing the market, in terms of increasing the depth of the market, in terms of coming out with new instruments, I think a lot needs to be done. I think some structured products were mooted, but there was a lot of resistance. Regulator came out with some specific regulations to curb some of them. I think there should be some way of increasing the resource raising ability through this market. I think which is very, very important at this stage.
Okay. Perhaps we can add or raise some questions to each of the participants. This question is to Mr. Ramakrishnan. You have assisted a finance services company, in a joint venture and things like that. We have seen the emergence of multinationals in manufacturing companies, whether it is Tata Motors, Tata Steel, Hindalco, so many of them. But not so many in the context of financial services companies. Why is this? What's probably holding them back?
I'll make an attempt. I'll probably quote an experience from one of the engagements we did at KPMG. And we observed a lot of things when we were doing it. So this is for a joint venture for confidentiality reasons, as Mr. Gurudas mentioned. So this is for a joint venture between a French bank, as in the security services arm of a French bank, and an Indian financial house. So as in they wanted to get into security services business in India. And the European player needed local expertise. They couldn't do it on their own. And they scouted a whole host of partners, potential partners in the Indian market. And I think most of their requirements were pretty straightforward. And they were looking at large commercial corporate houses which have a very strong financial services arm. Needn't necessarily just be a financial services player as an alone. So they were looking at a business conglomerate which could be the financial services arm of Mahindra or Birla Capital or Tata Capital. One of these, as in firms like these, were being considered as potential partners. And one thing which we observed, especially from the perspective, we were consulting for the European player. So as in we try to understand their mindset, as in we understand a lot of, as in what goes through in the Indian players, but it was fascinating and interesting to understand what goes through the European player. And more often than not, it's a standard perception that we have that they had set up shop in Hong Kong, they had set up shop in Singapore, and they were looking at setting up shop in India too from a long-term perspective. So a couple of reasons which I would like to highlight over here, which made the entire process last much longer than what we had visualized, which ties into what Professor Vishwanath says. It's not as easy as it is in the case of, say, other industries, some of the industries which he had mentioned about. The reason is if especially a foreign player is looking to partner here, and as in with the norms, regulations, caps, whatever be the case, the due diligence process, especially in this sector, since I've worked predominantly on this sector, it takes a humongous amount of time, and there's so many stumbling blocks, roadblocks, requirements from either parties, from a risk management perspective, protecting investor interests, catering to the not just the current regulations, but as in one of the reasons, as in where we pitched in is in terms of what could be the potential regulatory, as in the future regulatory outlook, which will impact this partnership and the business plan they had in mind. So one is the time taken in terms of, as in getting the partnership rolling on the ground. That was huge. So we had estimated a time period of around, say, a year to get this partnership and the operational model finalized. It took us almost 2.5 years. And still, in terms of the scale of the security services business, it hasn't really picked up the way we had estimated it to be. As in, for the European player, if it can work in Hong Kong, Singapore, with the infrastructure, with the fundamentals being strong in India, with the regulator, as in coming up with regulations and the market in tune with international markets. So, as in the potential needs to be realized, as in there's no reason why we can't realize the potential, but that hasn't turned out to be the case. So aspects like those and the gestation period, especially for such a venture in areas like these is comparatively higher than what they would face in, say, a Singapore or a Hong Kong. So parameters like those, I think, make especially the foreign players think a lot more. And one of the few reasons why, compared to what we would ideally like to have, there are fewer deals and partnerships which happen in the Indian context. Not that it's not happening, but ideally we would like to have more, considering the attractiveness, the potential, the growth which our domestic corporate houses have been demonstrating over the last decade or so. So I think that's my take on it.
Okay, thank you. This question is to Mr. Pai, who has had a lot of experience in leveraged finance. What are the lessons from these big deals to others? And do you see more and more transactions happening?
Certainly. I mean, we are already seeing that rub-off effect. You know, if you look at the history of acquisitions, outbound acquisitions from India, if you look at the first probably large transaction which attracted attention was the Tata Tea Tetley transaction. Right? That was around 300 pounds, maybe at that time less than $500 million kind of deal size. And that remained the largest outbound acquisition for almost 5 years till another Tata Group company bettered it with a $13 billion transaction. So nobody would have thought that from a 500 million largest deal size situation in India, one would move to a $13 billion acquisition made by an Indian company of a target which was probably 5 times larger than it in terms of capacity of steel making, and probably quite a few multiples in terms of valuations on enterprise value. So, you know, the Tata Chorus transaction has actually been a mindset changing, paradigm shifting kind of transaction. So many of the Indian corporates have actually understood that it is fine for them to look at deals which are larger than their own company's size. It is possible for them to do so because there are people who understand the targets as well as the companies in India and willing to put large amounts of debt on the table. So the availability of debt has been a very big contributing factor in a lot of entrepreneurs moving into this space. We are already seeing every company that you speak to in Mumbai. I mean, if you happen to meet any entrepreneur, what's on your mind? He'll say, I'm looking for some acquisition in Italy of some design house, or I'm looking for some fabrication unit in Oman so that I can cater to my Gulf clients. You know, even a small time 100 crore market capitalization kind of company is today talking about making some acquisition. Whether it's good or bad, we don't know. Probably there is a process of exuberance or wanting to be seen as moving in the international markets and going and doing deals. Or probably there will be a phase when some of them will burn their fingers and be lessons for the rest of them to follow. So probably that process is on. But today, every business house in India is looking at acquisitions, is looking for opportunities outside India. The question that you asked, if I may just add to what Ramakrishnan elaborated on international acquisitions, probably the outbound acquisitions by Indian financial houses, right? I mean, that's probably something which you wanted to also touch upon. There, I guess, the restriction, as Ramakrishnan mentioned, it's highly regulatory industry, right? So getting into financial services, let's say going and making an acquisition in Thailand or in the UK is not as easy as going and acquiring a Chorus or a Jaguar Land Rover unit. There are a lot of issues surrounding that. It's not simple, though the fact that Now, there was a time, we were just jokingly discussing that recently, rather this week, with other banking colleagues from other banks, that there was a time in 08 when the market capitalization of Citibank was lower than State Bank of India, right? So it means State Bank of India can put so much of cash and buy that bank out, and with the American culture, it's possible, right? As a commercial proposition, it's possible, and even today, let's say banks like Societe Generale or Crédit Agricole, they're all having a market cap less than SBI, despite being probably 5 times the balance sheet size of SBI. So it's not an improbability. The question is, can these organizations chew? Maybe there are a few players more in the private sector, maybe including Yes Bank, who can actually look at acquisitions abroad and assimilate those acquisitions into their organization and take the synergies from there. Whereas 70% of India's banking today is in the hands of public sector banks, which have made those acquisitions. SBI has made very small experimental kind of acquisitions in Indonesia, in Europe. They keep doing those once in a while. But the question is, do they have the ability to assimilate those targets into their own firm in terms of dissemination of the organizational culture or objectives?